We have the benefit of having a cross-section of investors on our panel here today. We have a family office, we've got a corporate fund of funds, a traditional investment advisor, and then 2 traditional fund of funds. So really, fundraising in the venture capital community has continued to evolve from traditional investors to the new faces that are representing the LP community. And our goal for today's discussion is for you as the audience to walk away with some insight as to what are current fundraising trends and really better understand kind of alternative sources of capital in the marketplace. So before we begin, what I'd like to do is go through some quick introductions. My name is Peter Curley. I'm actually a leader in the venture capital practice at Rothstein Cass. We are a national accounting firm with over 1,000 employees, and we actually focus on alternative investment funds. Actually, in our local Bay Area offices, we service more than 60 venture capital firms. With that, I'd like, Frank, maybe we can start with you, but if everybody could give a brief background of themselves and the type of limited partner that they represent.
Sure. I'm Frank Foster, and I manage the Gideon Hickson Fund, which is the venture capital arm of the Hickson family in San Antonio, Texas. We've been venture investing since the 70s in different forms, and our most recent incarnation, the Gideon Hickson Fund, has been investing since 1990. And we have a very sort of strict formula of we invest in managers with venture capital managers with under 100 million, usually in fund 2 or 3, and we invest in the managers and then co-invest with them in their most promising deals and act as a partner as they sort of go through the evolution of the fund.
Beezer?
So I'm Beezer Clarkson with SAP Ventures, and so I'm going to explain. SAP is our sole LP, as the name implies, and actually, I'm going to correct the slide, and my apologies, but it actually does such a great way for me to talk about the world that I sit in. So we are part of SAP Ventures, which is an independent GP, very closely affiliated with SAP, but we're the next generation, and I use this term because there isn't a better one, so if anyone has a better term, please help me. We are an independent GP with an LPA relationship with SAP, so they have committed to us like any other fund of funds. We are very aligned with them, and there are strategic reasons why they want to fund us, and it has to do with the power of big, real data. And we have a fund of funds focused on early stage venture, US, Europe, and Israel. It's about 400 million. We are looking at an 8 to 10 year investment horizon, and we're the new kids on the block. We launched last August. We also have a second vehicle I want to mention because that actually goes back many more years, and that's a direct growth vehicle. And again, it's corporate plus venture, same independent GP, same SAP as the LP, but that's also a typical direct growth venture fund.
I'm Anita Ng, and I am a consultant with Cambridge Associates. We are an independent consulting firm that provides investment advisory advice to our clients. Currently, we have over 950 clients, and that's globally. By number, 70% of those are endowments and foundations and other nonprofits, and that's where our roots come from. 20% are family clients, and the other balance, or the other 10%, is made up of public pensions, corporations, government entities, and insurance groups, etc. And I focus on private investments for Cambridge.
I'm Diana Frazier, co-founder of FLAG. FLAG stands for Frazier, Lawrence, and the Gang. We think of ourselves as a family. We were started in 1994 after I spent a dozen years being a GP on the venture side, both for a major bank and for a high-tech entrepreneur, and then got asked by a bunch of families to put together a fund because they weren't able to get into the best funds. They were only seeing the second and third rate funds, the only ones that came calling. So we started out not really understanding the word fund of funds. We called ourselves a consortium of families, 20 families, $100 million, and we just started. And then we're now 18 years later. We manage about $6.5 billion, and our clients are no longer just families. So I sort of run the gamut of all of these things here.
I'm George Arnold. I'm with Knightsbridge. We are a manager of a capital that's focused on venture capital and growth equity funds. We have about 1.2 billion in assets under management, and our LP base is predominantly institutional. We have some endowment foundations, public-private pension plans, insurance companies, and family offices.
Great. So in order to set the stage for our discussion here today, we're going to actually get each of the panelists' views on their perception of the venture capital investment landscape and where they see venture capital as a long-term asset class. George, why don't we start with you?
So, I think as other panels have already kind of discussed, we believe the inflow of capital into the venture space has become a lot more attractive. If you actually look over the last 4 or 5 years, the $15 to $20 billion that was invested on an annual basis is obviously a lot less than in the prior years. But I think even more importantly for us, because we are focused on the early stage side, if you dissect the numbers over the last 4 or 5 years, only about $6 billion was actually invested on the early stage side. So we think that's the kind of the most attractive part of the market. And if you actually go back and you kind of compare those numbers, to the late 80s, early 90s, where practically all capital on the venture side was early stage venture capital, because back then the IPO market was open for companies at a much earlier stage. And if you adjust for inflation, we're actually at a point where we have equal or even less amount of capital available for the company. So from that perspective, we think it's very attractive. I think the other thing and obviously that goes along with it is kind of on the LP side, a lot of the large investors out there, the $10 billion, $50 billion, $100 billion type LPs have really kind of retreated out of the asset class, and obviously I think that's one of the benefits that we think is, as long as that's going to remain the case, we think it's going to be very, very beneficial, for venture asset class in the longer term.
And Diana, thoughts?
What my opinion is, the venture industry probably isn't very interesting. Those of you who know me know that I am extremely bullish on the industry. I love it dearly. I have for 30 years. What I see is what's more interesting is what my LPs think about the industry. And what I found is that it's really, really, really tough. When we started, about 5% of our investors were advised. Now 99% of our investors are advised. And those advisors are in a really tough spot. They're in the middle. They encourage people to go into venture capital in 98, 99. Things looked lousy. So here they are sitting there now. Their careers are on the line. It's really hard for them to stand up and say, hey guys, this is a contrarian time. Now's a great time to get back in. So they're not helping you, the industry, get more money in because they're afraid to. Many of the individual consultants will come to us and say, oh my God, I want to put some money in, but I can't go to that board. They just blew their brains out on venture capital. What am I going to do? So what we're seeing is that's the real hard part, is this bifurcation of the audience.
Anita, your thoughts?
Sure. Well, I will respond to that. We definitely are still cautious with venture, at least for Cambridge, but we're cautiously optimistic. And no question, a lot of our clients and investors in venture have been burned for quite some time, suffering lackluster returns for an extended period of time. But also we are dealing with an environment where it's a very low returning environment in a lot of other asset classes, and so many of our clients are looking for not only private investments but specifically venture for that outsized return. And we are currently cautiously optimistic about the industry. As George discussed, the industry fundamentals and dynamics have improved, and they continue to improve. Consolidation began in 2005 and has accelerated after the 2008 crisis and continues today. So there's less capital overhang. There are the number of active firms are down. The number of professionals in the industry are down. VC capital raised per year is down, and fundraising is in a reasonable range and is below the amount that is actually invested per year and has been for some time. And we currently estimate that there's $43 billion in dry powder out there, and that's compared to $80 billion in 2002 and $67 billion in 2008. So it's come down significantly. We also do think that entry valuations have improved. There are still certain pockets where it's hot, but overall, we think that entry valuations have improved, and the exit markets have, begun to show signs of life. Still choppy and mixed, but definitely, seeing some signs of life, and we're just, hoping that we continue to see that sustained. And so we're cautiously optimistic, and our clients, I think there's a spectrum of our clients in terms of their risk tolerance and what they're willing to do, and many are treading slowly, but we are making recommendations into the venture area.
Beezer?
I appreciate everything that's said, and I don't want to duplicate it, so I'll just speak about two things that brought SAP to the fund of funds table, and that was both a strategic appreciation and a desire to engage in the thought leadership and the innovation that happens in the venture community, and understanding that is where significant growth and change occurs. And then also financial, so that we are structured as just a point to bring this out, we're structured like a fund of funds, meaning we're managed and looked at and viewed by our financial results. So we have a fee, we have a hurdle, we have carry, and it's that duality that makes, that SAP is looking for, right? So at the end of the day, I'm going to be measured on my financial returns, and they're looking for that as well.
We get to look at it through a different lens, which is, over a 25-year period, there's going to be ups and downs, and we're an evergreen fund, so I don't have the same vintage requirements as other groups. Really what we like is actually when everybody hates venture capital is a great time for us to be investing, and we were very active in 2007, 2008. So we continue to be excited about what's happening in venture. There's always going to be new, exciting deals. I think you have a little bit of advantage when you don't have sort of the constraints of a vintage to be able to go against the cycles a little bit.
And, as I mentioned before, we're fortunate enough to have a cross-section of investors that represent a myriad of limited partners. And so with this next section, what I'd like to do is, and we did this by design where we've got the managers who represent a single limited partner at the end. We've got Anita, Switzerland in the middle, and then we've got the fund of funds on the right side.
I like Switzerland.
So Beezer, you represent a single corporate limited partner, and what considerations does that play into when you're selecting managers, specifically with sector size and the lot?
Trying to think of it. So SAP's interest in doing the fund of funds, their strategic rationale was that they really want to be catalytic and help engage in discussion around big real-time data. So that's one line of sight that we think about. But because we are measured by financial return, I am looking for the same financial return that my presumption is that all my colleagues here are, and we're looking for managers that can produce a 3 to 5x, and that goes into why do you think a specific manager can do that, right? Which we can leave for a different question. So I would say those are the biggest guidelines that come out of having our LP, but they don't come in and say, and you shall do X, Y, and Z. That's not how our LPA is structured. The point is to be able to look for the best managers that we can find.
And Frank, with I know you have a very interesting strategy where you're investing alongside some of your funds in a direct manner. So how does that affect what types of managers you're choosing, and does your single LP have any limitations on the types of investments you're making?
I mean, other than not investing in sin industries, unfortunately, no. For us, it's really been finding managers who we believe we can really work closely with, that will, talk to us, talk about the good, the bad, the other things. Because our hope is we back them, they grow. What we really hope is they get 4 or 5 really good investments out of a fund, and we can be in 2 or 3 of them. I mean, it's not, magic, and it means that we may have funds that didn't perform particularly well as a fund, but were really, really good for us. And actually, it's been surprising how many of the funds, end up having that 3 to 5 really good investments. We get in 2 of them, and that's how we can have double-digit returns for 20 years.
George, I know we were talking outside when you're launching a new fund, you really have to think about your limited partners and the mandate that you're setting. So how much influence does that have, on the types of investments you can make? And is that before you launch the fund, during the fund?
Yeah, so our limited partners, obviously, some of them are going back, to the beginning of Knightsbridge, 30 years. So, and we haven't really changed our strategy, kind of, focus on the early stage side. So, as a result, kind of, LPs know more or less what to expect from us. But we have about half of our LP base is actually in Europe, maybe even a little bit more than half. And so, as a result of that, a specific example would be that some of our European LPs would say, we're really interested in getting exposure, to U.S. venture capital. That's typically, where obviously all the big returns have come from. And to the extent that they have an interest in Europe, they either can do that themselves because they're based there, or they say we don't really have a whole lot of interest. They obviously cannot take, any investment decisions, but we would just tell them, to the extent that we consider any managers in Europe, this may be the 2-3 names that we would consider, and we wouldn't go beyond that. But other than that, I mean, the LPs have an influence at the time that that the LPA is crafted in terms of setting general guidelines. But then beyond that, we really follow the strategy that we outlined as part of the fundraising process.
Diana, would you agree, or do you have any different thoughts?
Not really. We have 4 different products, but in the venture area we have 2. One are domestic and one are international. So clients get to choose where they want. But within our domestic, we're very balanced, and I think you're going to talk more about that later. But one of the things that's interesting is maybe you've seen some of the research that we did about the number of active funds that's gotten a lot of press, both negative and positive. We set the same criteria for counting who's active out there. So it's did 4 or more deals totaling $4 or more million. Doesn't have to be 4 $1 million deals. And we counted that up using the exact same criteria starting in 2000. And in 2000, there were 441 funds that qualified for that. And now we counted last year, there were 89. So in our terms, the question was, what do you think about the quality of the base out there? We think the quality has gone up dramatically as it's focused and refocused on smaller funds, smaller number of funds.
So you think the quality of the investment options has continued to increase?
Improve, absolutely. So we think our job is the same as it's always been, always trying to be in the very best, but we don't have to look at 441, we have to look at 89.
And Beezer, I know you're actively investing. Would you agree that the investment options out there are good right now?
I do agree, and I think, and this isn't new news, it's been discussed all day, there is an active change in the venture market, right? I mean, people tend to forget sometimes that Andreessen Horowitz only came on the scene a few years ago. I mean, there's been some real change with the accelerators and incubators, and that's just over the last 5 years. And if you look over 10 years, you see other changes. So it's the industry itself keeps sort of adapting and moving, and that helps, along with this contraction of the number of managers, to keep options interesting and fresh.
And there's been a lot of talk about returns today and yesterday. And Anita, you're fortunate enough to work with a number of different limited partners across a number of different sectors. So when your clients are looking at the venture capital asset class, are they looking for risk-adjusted returns, or is it really that outsized return?
Sure. We do customize our programs and portfolios and recommendations for individual clients, and that's based off of their size, their risk tolerances, their preferences, etc. But if I were to generalize, it is looking for that outsized return. If I were to, again, generalize in terms of return expectations and what I would expect, I kind of echo what Beezer said, looking for an individual venture firm, I think it's absolutely reasonable to expect them to generate, a 3 to 4 times return, and aiming at the deal level to be, at least a 5x return. That's a very high bar. I mean, it's probably only achievable by just the top quintile, not just the top quartile. But I think that's a reasonable expectation. What's more realistic for a venture program as a whole, though, when you have all your managers, I would say that's lower. Maybe in absolute numbers, you would expect, early stage to have maybe a 2 to 3 times return multiple over the long term, and late stage a little bit less, for a program as a whole. And just to put that into some context, with the data that we have, we track over 1,300 venture funds, and I'm just counting the ones that were raised from 1981 to 2008, leaving out more recent vintages that are too young or immature. And it may or may not surprise folks here, but they're within that long time period, only 20% delivered over a 2x return in terms of distributions, and only 10% delivered a 3x. So and you've got some big, boom years, bubble years during that period, 1981 to 2008. So it's a high bar, but I think that's the proper expectation to have. If I were to look at it from relative framework versus the public markets, and obviously being in this asset class, why are you in it? Why are you suffering the illiquidity? You have to have some premium toward over the public market performance, and I think generally we would say at least expect 500 basis point premium for an early stage venture firm.
And there's been a lot of talk. Some of the general partners were talking about IRR, and Diana, I know we were speaking last night, and you mentioned you're really focused on multiples. How do you evaluate funds? Is it multiples or is it IRR?
Well, you have to look at the IRR as well, because if they return 4x over 100 years, it doesn't make sense. But we started out with very high net worth families, and I always say you can't spend IRR, so you can have a quick hit, a quick flip, flip something in a couple of months, and you have this phenomenal IRR. So too many funds play that game. So one of the things that we have to do when we do our due diligence is really look at how the IRR was calculated. If they juiced it up with a few things in the beginning, or in the fund-to-funds market, buying some secondaries just to make it look good, that's not real. You can't spend that in the ultimate end of the day. So we try and steer people back to, hey guys, give me $1 and I'll give you X back. That's what you should care about.
And Frank, you mentioned earlier you have an evergreen fund.
Yeah.
So in talking through IRR and multiples, how does having that evergreen fund and really that long-term time horizon, affect the decisions that you're making when selecting managers?
Well, we get measured on an IRR, but that's not what really makes the family happy. What makes the family really happy is when one of the managers finds a great deal and it's a big hit, and I get to send a big check back to the family. It's pretty simple. So we're looking for lottery ticket type of potential, which actually has a lot to do with what kind of managers is this the kind of manager that's going to go out and find one of those deals? Is it the kind of manager that will then let us know and share it with us, and use us as a partner on doing that? So it's very much for us a relationship, because over time I think most of the managers come in at about 1.5 to 2x. That's what we've found, and so that's okay. But we're going to get our alpha on the lottery ticket deals, and that's what we've really looked for in those relationships.
And then George, on the other end, you're dealing with more of a limited life structure. How does that create a lot of constraints when looking at underlying managers, and how do you deal with that?
Well, no, it doesn't create really any limits for us. Our funds are structured as a 15-year vehicles, and the rationale for that is essentially our investment period as a fund of fund is 3 years. Our funds are essentially 10-year funds, typically with at least 2 1-year extensions. Now, if you look back historically, actually our 1989 fund, if we still had that on the books, would still have 1 company left, and so it would actually still be active after whatever that amounts to, along 23 or 24 years. But what we do is, to the extent that we go beyond the 15 years, we work very closely with our LPs and try to determine whether they're interested in extending the funds or not. The good news today is, as long as we don't have a financial crisis like in 2008, 2009, there's actually a good set of secondary players out there, and we've with some of our older funds, we've offered liquidity for our LPs at the end of the fund going to the secondary market, and we've actually gotten very good pricing, kind of a 15-20% discount to NAV for these older funds that our LPs were actually very happy to kind of accept and get the funds wrapped up, because for them, having very small NAVs on their balance sheet just doesn't make a whole lot of sense.
So in really thinking about portfolio construction and setting up your fund, Diana, what percentage of your managers are emerging managers versus existing managers? And maybe before you answer that question, what is the definition of an emerging manager?
Wow.
And maybe we'll go down the line with that question.
Yeah, just that one question.
What vintage?
We used to have a product called Next Generation, and people would look at it and say, wait, it's got Roman numeral 2s and 3s in there. Those aren't emerging. They are emerging. They're still emerging, and one of our criteria is sort of, has it made it to the next generation? Is it the same two guys, Fund 1, Fund 2, Fund 3, have they been able to build a team? Now, I'm not saying that you have to build a team. Maybe the fund will die after 3 times because they're going to retire, and that's fine. Let them do that. I'm not saying that we only invest in funds that promise me they're going to be around for 100 years. But I'm saying when we're looking at what we call a franchise fund, it's one that successfully made it to the next generation, as opposed to an emerging manager, which is newer and is still the same people. We put Bain, for example, Bain Ventures, in our next gen product. And people said that was crazy. Bain's Bain. I'm saying, hey, this is a brand new team. They've never done this before. They go in our emerging bucket.
Yeah.
And Frank, on the other end, how do you look at emerging managers?
We found sort of a magic sweet spot. It's interesting with what Dan's saying, because really, Fund 2, Fund 3, in the $50 to $70 million range has been kind of the best relationships for us. Great returns. You get partnerships that are starting to find their groove on their investing. You're able to, just the whole thing of how you work them at their annual meetings, everything is kind of going and working at that point, but they still need you as a partner. I mean, by the time they're on Fund 4 and have $600 million under management, we're not, such an important partner to have anymore, so it doesn't sort of fit for us. But that's okay, because it's usually people now who are friends in the industry, and whether we're still investors in their funds, they're still part of the overall ecosystem for us.
And Beezer, thoughts?
Yeah, the emerging manager definition is a bit of a moving target. I agree. Because, so I would say the majority of our funds fall out within 2, 3, and 4 for sort of similar reasons, and also because given our fund-to-fund size, we have tended to focus at the $250 million and less venture fund size. And those don't always have to be earlier in their lifetime, but there have been many that we've been looking at, especially some of the newer, more thematically oriented ones. We've seen a number of enterprise funds, which shouldn't be shocking given my LP. But that just has ended up weighting a bit more towards the newer ones. And there, as Frank was saying, there's some really great dynamics when you have a newer enterprise of the venture fund itself.
And Anita, does Cambridge have a definition for emerging manager?
No, I mean, I would echo the panelists. I think it's case by case and figuring out, how established a group is in terms of their track record. I mean, if I were to cut it, it'd be like funds 1, 2, and 3, just to generalize. But there are certainly situations or firms that fall outside of that.
And going back to my original question, George, when looking at the breakout between emerging managers and existing managers, what would you say your percentage is in your breakouts?
So existing managers defined as kind of managers that raise higher Roman numerals. So we invest roughly 80% of our capital involved. We kind of call the established top tier managers, and then we reserve roughly 20% of the funds for newer or emerging managers.
Okay. And Beezer, down on your end, is that a similar or inverse?
Well, we haven't created a sort of fundamental rule and saying we would only do X or Y. I just looked at my portfolio prior to coming here and realized that we did have a majority of emerging managers given the definition of vintages 1 through 4. However, we're in the first inning of our fund of funds, so I would anticipate that would shift over time.
Okay. And Diana, are you any different?
I think we're a little bit higher. Well, I guess it's changed over the years. In the old days, it was all about access, and you only had to be in the brand names, the really good brand names, and that was it. That's all. So the game then was fighting to get into those very best names. I'd say there was a sea change starting in '05, where some of the older names lost their luster, got sloppy, got big, whatever. And we had to go really more proactively look for these emerging managers. So in '05 we really started, Spark might have been one of the first, and then we've done more. So I think the shift has changed from maybe 10% to now 25%. But it might be more than 25% by number as opposed to dollars, because our emerging managers are usually smaller, so we have smaller dollars with them. So there might be more of them, but when you add up the dollars, it's 25%, but not by number, if that makes sense.
Absolutely. And Frank, with a single limited partner, does that allow you to take some more risks and look at more emerging managers?
Yeah, I think so. I mean, there's kind of a commitment to this program which is a little bit different. If they were just looking at this in the line of, all right, this is just another place to park money, and we need this type of general return, but it's not how they look at it. They look at it as this is a chance to, not just invest, but get superior returns and make a difference with what they invest in. So there's a little bit more of an emotional component, I think, with a family office, where they want me to have a guideline of they'd like to see life science investments. They'd like to see clean tech investments. And there's always a thinking which is, with sort of clean tech, I think some of the earlier panels said it's sort of getting interesting again because everybody's starting to hate it. That's when we'll look at that, but we'll be looking at it with our managers who are living, in that world all the time.
And Anita, you see all sizes of limited partners. So, in thinking about emerging managers, do size constraints come into play when trying to allocate our money to smaller managers?
Our client base is very, very wide range in terms of size. So yes, on the larger end, where we're working with a group that is a couple $100 billion in overall pool size, ventures is tough for them to access, of scale to move the needle. But I would say most of our client base and our sweet spot is generally around the 500 to 2 billion size range of ones that we actually work with on a comprehensive basis and build their portfolios out. So I don't think that's as much a consideration. I think, and I don't really look at it as emerging versus established or emerging versus existing. In terms of the number of funds and the funds that we track, I would say maybe 40% of the overall universe that we track is in that emerging kind of fund 1, 2, 3 stage. But when I build a program, I'm looking at the whole package for a manager. Looking at the track record, whether it's a team that has been in the same firm or a team that has worked together in the past, and has developed and pursued that strategy for some time and has some success doing it. So it, for me, when I'm building a program, it is looking at manager by manager and not really distinguishing whether or not it's emerging or existing.
And there's really been a growth in that angel and seeds stage managers, kind of sub $50 million managers. Are any of you interested in that stage, or do you have thoughts at all?
Well, we've made some investments in that phase, in that stage, so we're certainly interested. It has some slightly different considerations than larger funds. I mean, every fund you look at, you have to think about, does the size fit the strategy? What is the strategy? Can you look at the manager and understand what they're doing? And to the question you had posed to Anita, there is always different questions around how much can you put to play in a different manager. So there are funds that can be very small, and that does cause challenges for some LPs. Certainly it's caused challenges for us on occasion as well.
Any other thoughts?
We haven't, because we tend to like managers who are a little bit more vested in their deals. That the incubator model, you get a lot of product, but what we really like is finding after 2 or 3 years, what do the guys that we work with really care about? What are the companies that they're most excited about and are putting themselves on the line for? Those are that's what we're really looking for, is to get into those type of relationships. So it hasn't really fit as well for us to do the incubators.
Oh, I wasn't specifically limited to incubators, but I agree with your point. One of the challenges in the smaller funds is ownership, right? And does that model work? And can you get a 3 to 5x? And depending on the model and the things, some of them can.
Any ideas on the larger fund size end?
Well, yeah, I mean, for us on the small end, there are a lot of new funds. I think Diana was quoting the 80 plus active funds. If you actually look at data, median fund sizes, kind of funds raised in a quarter are down somewhere in the double-digit numbers, which obviously means that at least half of the funds are kind of these smaller funds. And then on top of that, you have a lot of angels that we don't even track, or that the industry has a very hard time tracking. And while there are clearly interesting managers coming out of that space, we think it's actually a space where potentially there's really a lot of overfunding going on. There's some people are kind of trying to estimate the amount of capital that's being invested on that side. And estimates kind of range from anywhere from 2 to 10 billion on the seed angel side. If you take the $6 billion number on the Series A, on the early stage side, Series A, Series B side, and you recognize there's probably roughly a factor of 5 to 6 the more capital that's needed for Series A, Series B. If you really have 5 billion or so invested on the seed side, times 5 times 6 gives 30 billion. I mean, there's a huge problem there between kind of the capital that goes on the Series A, Series B side and the seed side. So I think we have been very careful, in that space, because as I said, we think there's just a lot of competition in that space, and I think people are not going to, make the big returns that they think they're going to be making just because they invest in a small fund size in general.
And we've got about 5 minutes here, so I'll open up to questions. But one final question for Diana. In looking at recommitting versus backing away with an existing manager, I think a lot of the value add that a fund-to-fund provides is knowing when to do that. So how do you look at that?
Yeah, that's really, I didn't know you were going to ask that question, or I would have given you some specific numbers on our portfolio, but I can say since 2005, when we made that strategic switch, we have turned down more existing managers than ever in our prior 13 years history. Just because, an automatic re-up should never happen, but we actually came to a point where there were a bunch of funds that had just gotten too big and too sloppy. So we have had enormous turnover in the last few years. Now, most of those funds that we turned down were not because they were necessarily bad. They're actually going to be accretive to our portfolio. But sitting here today looking forward, we're saying, I don't think they're going to be able to continue to do that in this environment. They're too big, whatever. So we have dropped a bunch of managers.
Any other thoughts on that?
For us, it's often they grow out of us. They are managing north of 100 million. It's usually a measure of their own success in doing that. But they just we don't find the same opportunities to co-invest. And frankly, the relationship often changes when they have more money in their management or more worried about how much money they can get into a deal. And so we've found that there's been a natural evolution out of those managers over time.
So we've got a few minutes left. I'd like to open it up to the audience. Any questions for our panel?
Can you talk a little bit about the commitment size you make for funds? And can you talk a little bit about the commitment size you make in funds in the sort of $50, $75 million range?
We target usually first relationship 1 to 2% of a fund that's raised. It's sort of our usual entry chip in, and then it has changed over time with our relationship and how the family feels about putting more with that manager or not, given the way the relationship is going.
A full position might be 15 to 20 million in a well-known fund, and then in a small fund maybe 5 million.
Any other questions? Why don't we thank our panelists? Thank you guys.